Welcome back to Investing Talk Podcast.
Great to be here.
Today, we're taking a close look at Affirm Holdings. They've got a pretty significant earnings report coming up soon.
That's right. Lots to unpack there.
Exactly. So our goal, like always, is to sift through all the noise, the analyst stuff, company news, market buzz, and really zero in on what matters for you.
The key takeaways.
Precisely. Now, before we jump into Affirm, if you find what we do valuable, please think about subscribing, maybe liking this episode, or leaving a comment. It really helps us out.
Yeah, your support keeps us going. And drop a comment if there's another company you want us to explore.
Absolutely. And you can always consider buying us a coffee, too. The link's usually somewhere below. Okay, let's get into Affirm.
Let's do it.
All right, so this upcoming earnings report, we've got a fair bit of info here. What are the absolute basics we need to know? Like, when is it, and what's the general vibe from analysts?
Okay, so the date is locked in. August 28th, 2025. It's going to be after the market closes that day.
After the bell? Standard procedure?
Yep. And looking at the consensus, well, last quarter, Affirm pulled in $783.14 million in revenue. That was pretty hefty growth, like 35.9% year over year.
Wow. Yeah, that's strong.
It is. And for this quarter, analysts are kind of clustering around the high $780 million to maybe $800 million mark. So they're expecting that growth story to, continue.
Okay, so revenue's expected to stay robust. What about the bottom line, the EPS?
Right. Earnings per share. The main consensus number floating around is $0.09 per share. 9 cents.
Positive territory, which is interesting for them.
It is, though you see some variation. Some aggregators edge it up towards 0 and 11 cents.
Mm-hmm.
And then you have the whisper numbers.
Ah, yes, the whispers. Always slightly more optimistic, usually.
Often, yeah. And they're pointing towards 0 11 cents, too. The company itself, well, they didn't give super specific numbers last time, but they did talk about keeping positive adjusted operating margins.
Right, focusing on that core profitability.
Exactly. And also maintaining strong sequential volume growth. So the theme was definitely growth, but profitable growth.
Okay, so we've got the date, the expected ranges for revenue and EPS. Good baseline. But how does a firm usually do against these kinds of predictions? Do they tend to hit the mark, or are they known for surprises?
That's a great question. Looking back, Affirm actually has a bit of a history of positive surprises.
Oh, really?
Yeah, in the last 4 quarters, they've beaten the consensus estimates, I think, 2 or 3 times. Sometimes it wasn't by a huge amount, but, a beat's a beat. Like Q3 2025, their actual EPS was a penny, 0 rotor 1 cent. The estimate, -9 cents.
Okay, that's a pretty significant beat. 10 cents better than expected.
Exactly. And revenue edged out expectations too, just slightly, but still a beat.
Yeah.
So it suggests they either manage expectations well or, they just execute strongly when it counts.
That track record of beating is definitely something to keep in mind. But what happens to the stock after the report drops? Is it usually a smooth ride up on a beat, or is it more chaotic?
Oh, it's definitely not smooth. Chaotic might be good words some quarters.
Seriously. The stock has shown really significant volatility right after earnings. We're talking moves of like 8% to 15%, sometimes even more, up or down.
Wow. Okay. So buckle up territory.
Pretty much. And the initial pop or drop isn't always the final word. Remember that Q3 beat we just talked about?
Yeah.
The stock initially jumped, looked positive, but then as people dug into the guidance and thought about the bigger economic picture, it actually reversed course later.
Interesting. So the details in the guidance and the macro context really matter, not just the headline beat.
Absolutely. And speaking of trends, beyond the headlines, revenue growth, like we said, was strong, around 36% year over year last time. They're also slowly, gradually improving towards breaking even on EPS.
That's key.
It is. And GMV, gross merchandise volume, basically how much stuff people are buying using a firm that's trending up. Active users are growing too, all good signs for the core business.
But there's always a but, isn't there?
There usually is. The challenge for them consistently has been expanding their gross margin.
Why is that? Well, 2 big reasons. Higher funding costs. It costs them more to borrow the money they lend out, especially with interest rates up. And second, it's a really competitive space now. Buy now, pay later. Lots of players fighting for market share.
Right. That makes sense. Competition and funding cost squeezing margins.
Okay.
So knowing that history, the volatility, the margin pressure, what's been happening this past quarter, any big news, partnerships, or market shifts that might color this report?
It's been more steady progress than huge splashes this last quarter. No massive game-changing announcements specifically from Affirm.
Okay.
What they have talked about is continuing to build out partnerships. integrating with more big e-commerce sites, more retailers.
Makes sense. Driving volume.
Exactly. The goal is to get Affirm in front of more shoppers, especially for things like summer travel bookings and then the back-to-school season. Those are big periods for them.
So strategic blocking and tackling, expanding their reach. Got it. Zooming out a bit then, how's the whole buy now, pay later sector doing, and what are the bigger economic forces at play here?
Well, the overall trend for BNPL is still strong growth. Consumers are definitely adopting it, getting comfortable using it. That's the tailwind.
Okay, good underlying demand.
Yes. But the headwind is pretty significant, mainly from those higher interest rates we mentioned. It hits their borrowing costs directly, and it potentially impacts credit quality too. If consumers are stretched thin, delinquencies could rise.
A double whammy from rates.
Sort of, yeah. And U.S. consumer spending overall, yeah. It's been holding up, generally.
Yeah.
But it's patchy, strong in some areas, weaker in others. So it creates this kind of mixed, uncertain picture for a company like Affirm that depends on consumer spending.
Uncertainty seems to be the theme. How are analysts reacting to this mix? Are they still bullish or getting more cautious?
It's definitely leaning more cautious or at least balanced. You see a lot of neutral or hold ratings being reiterated.
Okay.
The reasoning is often that the stock price already reflects a lot of the growth.
Yeah.
Potential high expectations, basically.
Yeah.
And analysts are pointing to those same macro risks, the tighter lending environment.
So the bar is set high and the environment is tough.
Pretty much. That said, it's not all doom and gloom. We have seen some analysts slightly nudge up their price targets recently.
Oh, why is that?
Seems to be driven by some signs that consumer credit losses might be stabilizing a bit, not getting drastically worse. So a little glimmer of positivity there, but overall the tone from analysts is quite measured.
Measured. Okay. So you've got this company with a history of beats, but facing headwinds, cautious analysts. What does the stock chart look like heading into earnings, and what's the options market saying?
Well, the price action leading up to the report has been interesting. Affirm shares have been hovering around the $75 mark.
Okay.
Not really a strong run-up or a sharp sell-off, more like consolidation, kind of treading water. Maybe a slight bearish tilt as some short-term folks likely take profits or reduce risk before the event.
Right, typical pre-earnings jitters. And the options market, is it betting heavily one way or the other?
It's pretty balanced between calls and puts in terms of open interest, but there is a moderate skew towards puts.
Meaning more protection buying?
Yeah, that suggests more hedging against potential downside rather than, piling into calls hoping for a massive surge. But the really striking thing is the implied volatility.
How high is it?
It's significant. The options market is basically pricing in a potential move of plus or minus 12% to 14% just from this earnings event.
Wow, 12 to 14%.
Yeah. And that lines up pretty closely with how much the stock has moved after earnings historically. So the market is definitely expecting fireworks, one way or the other. They're anticipating a substantial reaction.
Okay, expectation is high volatility. So let's game this out. Given everything we've discussed, the history, the headwinds, the market pricing, what does a good report look like? What's the bullish scenario? And what's the bearish outcome that validates those put buyers?
All right, for the bulls, what you'd really want to see is a clear beat and raise.
Beat estimates and raise guidance. Classic.
Exactly. So EPS needs to come in comfortably above that 0.9 cents, maybe even above the 0.11 whisper number. You want to see GMV growth accelerating further. And crucially, signs that credit quality is stable or even improving low delinquencies.
Stable credit is key.
Absolutely. And then positive, upbeat guidance for the next quarter, Q1 2026. Any bonus points for margin improvements or maybe announcing a splashy new partnership could really fuel a rally.
Okay, that's the bull case. What about the flip side? What triggers the sell-off?
The bearish scenario would be a miss on either revenue or EPS, so coming in below that 0.9 consensus. Or even if they meet estimates, maybe disappointing volume growth.
Stalling growth.
Yeah, or any signs that loan delinquencies are actually ticking up. That would be a major red flag. Margin compression continuing would also be bad news. And then weak guidance or even just cautious commentary from management about consumer health or the economy, that could easily send the stock tumbling.
So, missing numbers, rising bad loans, weak outlook. Got it. When the numbers actually drop, what are the 2 or 3 specific metrics you'd tell people to focus on immediately?
I'd say number one is that gross merchandise volume growth. Is it accelerating, decelerating, holding steady? That shows underlying platform usage.
Okay, GMV growth.
And number two, arguably even more important sometimes, is the forward guidance for the next quarter, both revenue and profitability guidance. That tells you where management sees things heading.
Right. The outlook often moves the stock more than the past quarter's results.
Often, yes.
Yeah.
Investor confidence really hinges on that forward look.
So putting it all together then, after exploring all this, the history, the market, the potential paths, where do we land? What's the overall take heading into this report?
Weighing everything, it still feels pretty neutral overall. The company's execution has been pretty solid lately, hitting their marks.
Yeah, they've delivered.
But those headwinds, the macro environment, the competition, the funding costs, they're real. And analysts are right that the valuation might already bake in a fair bit of good news. So there's just a lot of uncertainty swirling around.
A neutral stance then? Makes sense given the push and pull?
Exactly. And that uncertainty is why the options market is pricing in such a huge potential move. It reflects the wide range of possible outcomes.
So for listeners, what does that mean practically? If you're risk averse.
If you don't like holding through earnings might be uncomfortable. It's kind of a binary event risk. Waiting for the dust to settle after the report gives you much more clarity.
Makes sense. And for those with a higher risk tolerance.
Well, if you believe a big move is coming but aren't sure which way, strategies that bet on volatility itself, like a straddle or a strangle, could be considered. But that requires the actual move to be as big or bigger than what the options are pricing in.
Right, you need the volatility to materialize.
Precisely. And then for the long-term investors, people who believe in the buy now, pay later trend, fundamentally,
Yeah.
this earnings report, even if it causes a short-term drop in the stock price, could actually be seen as an opportunity. If you like the company long-term, a significant dip might be a chance to add to your position or start one. It depends on your time horizon and conviction.
Right, seeing past the immediate noise, this whole look at a firm really highlights something important, doesn't it? Even with tons of data, earnings are never fully predictable.
Never. There are always variables.
So as you, the listener, look at a firm or any company's earnings, maybe think beyond just the headline numbers. Consider the story. Is the company showing resilience? How is the whole sector changing? What are those bigger economic tides doing?
Yeah, how does this one snapshot in time, this one quarter, fit into the bigger, longer-term picture for the company and its industry?
Exactly. Keep asking those kinds of questions. It's key as you navigate your own investment journey.